Hey, good morning. It's a Thursday. Let's get going. Time to trade Forex. So, good morning. Welcome to the Forex.today YouTube channel. Like I said, it's Thursday something. Thursday what? Hang on. Thursday, the 27th of September, 2018. So your daily Forex trading strategy session, hosted by Forex.today, brought to you by Traders Way. Traders Way is a boutique foreign exchange trading firm, and I'm trying to earn your loyalty and respect by sharing my years and years and years and years of experience trading Forex, fundamentally, technically, from scalping, spotting, swinging, positioning. Try to share all of this with you with the hopes that you become a conservative, confident trader that is profitable, focusing on the long term, not risking money you cannot afford to lose, treating your Forex as a business, not as a video game. And through all that, hopefully, if you do develop the skills that you need to trade wisely and profitably, perhaps you'll choose Traders Way as your prime broker for your successful Forex trading business. So in a sense, we're investing into you up front with hopes that we simply earn your loyalty and respect, and then today, and then maybe someday soon, we'll earn your business as well. Oh, you like this cup? I actually made this like 20 years ago. Yeah, one of those little, paint your own stuff thing. I don't know if you can't quite see it, but I got like a logo on the bottom. I don't know if you can see this without me spilling. It's got my name in it. Yeah, anyways. Cappuccino. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, so please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. And just in case I haven't introduced myself, my name is Wayne McDonald. Nice to meet you. I'm a foreign exchange trader. Oh my goodness, what's a foreign exchange trader? Well, it's pretty straightforward. I have to know everything and then accurately predict the future every single day. But besides that, it's pretty straightforward. Oh, yeah, I buy and sell money. That's what I do. So, might as well zoom in. Yeah, Charles asks, with 10-year T-notes comfortably over 3%, it doesn't matter. It does matter, in my humble opinion. Oops, let's go to, I know what I'm doing. There we go, that's what I'm missing. Yeah, it does matter, and to me it was a turning point. So I think it was like May, where we went over 3.0 the first time. Let's get some of those lights out. Right? I think it was May that we went over the first time, and that was significant, where we went well over 3%. And to me, it was a turning point. It really was. So what that tells me is that the trends that are supposed to be in play are in play. For example, the bond market is supposed to come down. The Fed's not buying bonds anymore. It's supposed to come down. So it takes a while for people to unwind from these positions. And breaching 3.0 earlier in the year was a significant turning point where, okay, yes, the stock market was going up for years and years and years, but then the bond market was propped up by central banks. So, with the move of the bond market now, bond prices falling, which means interest rates are rising, that was what is supposed to be happening in that scenario. And that means it's less and less influenced through artificial supply and demand. Okay? Right? So, yeah, now that we're over 3.0, then that's good. That's healthy because it's supposed to be. All right. So you could do some little research if you want. You could say, well, back in a normal world, if you had, 3 or 4% GDP, what were interest rates when the market wasn't influenced by central banks, but by regular market participants? And you might find that there's a discrepancy between now and then what is normal. So we're in that process of normalization, and interest rates going up is a good thing. Okay? So anyways, let's start with our normal setup. Okay, USD CAD, So where we left off, I think it was Tuesday, is that, Monday there was a buy for buy zones, and it was really Friday if you're front running it. If you're a bull, there was a buy zone. You could see it's a monthly pivot, not just, anyways, a monthly pivot on top of a weekly target. Okay? And that's where bulls would buy. This other area that we identified more like Tuesday was if you were a bear, you look at this roll reversal to the left, right? Drag it to the right, and then you add the weekly pivots into here, and you got your sell zone. And one of the conversations we had on Tuesday about this is you can never know which one's going to work, right? That is, let's see, it's predictable, but it's not something that you can control. So the thing that you can control is your bias, right? So it's very predefined stuff. If you're a bull, you buy here. If you're a bear, you sell there. And that's that. And once you get used to that and fit your bias into market conditions and stuff, buying at support or selling at resistance, you'll do just fine, I think, on the long run. So here, if you bought it here, well, it didn't work the previous one, and maybe didn't work the previous one. Well, that's all right. The market hasn't, the market was more bearish. But bulls still had an opportunity to make a little bit of money here, even when they were, quote unquote, wrong. They weren't wrong for 36 hours. So another way of saying it is they were profitable for 36 hours, and then it dropped. All right? And then it dropped where it was supposed to, by the way. So in this case, you try it again. You're a bull. But this one's a better buy because we talked about it 2 weeks in advance. Right? If you remember drawing the triangle saying that this was a place where you'd look for a change in direction or a change in trend, say I. How many people remember drawing that triangle and making it important? It was a reminder, right? It was a reminder of the bottom. That if we were down here, this is where you look for a potential change in trend. Okay, so it's important, not that it went up. The important thing is when it was falling, we were already thinking about not just our trades, but other people's trades. Okay? As it was falling, we said, oh, well, and I think actually we were looking at this from a bullish point of view. So we had two trade plans, I think, back then. One was buy it here. The other one was buy it here. And then we said, well, because of if you back out, going back like a month, you can see that would create a double bottom, and it's a monthly pivot point, and it's in that weekly target zone where bears are supposed to get out. So this is very important. It's a cluster of support, and if it held, it would create a double bottom, which double bottom is a potential reversal pattern, and oh snap, it reversed there. Not here, not here, not here, but at the double bottom. So I think that's critically important. Doesn't mean if you're a bear, you don't sell here. As a bear, you're supposed to sell there. And as a bull, you're supposed to buy here. Okay? So now what? Well, it's still the same thing. If you were a bear, where would you sell? Well, it seems to me this target that I drew is probably a pretty good area to consider. Let's drive it into a 1 hour chart. Okay, if you're a bear, you should say, well, bulls are supposed to take profit somewhere in that red zone, and there's a monthly pivot in there. Let's see if I can squeeze this in a little bit better. Okay, so if you could sell in here, that would be interesting if you were a bear, right? What if you're a bull? Well, you can't buy there. So now you come up with your plans. Well, what if it dropped a little bit? Where would you buy it? Okay? If it falls, then what are you going to do? If it rises, then what are you going to do? So to me, if it falls, it's buyable. If it rises, it's sellable. So I think when you get near 131, as a bear, you should start looking for opportunities, probably even on a 5-minute chart. Right? Because if you're selling, let's say, let's go back to an hour. I can just fit time better in there. Let's say you're around 131. You observe an opportunity to sell on like a 5-minute chart. And where would you put your stop? Your stop would probably be here. So that's about a 50 pip risk. Okay? What would you do, huh? Hey, by the way, check that out. All right, so let's take a look at WTI. Our target here was $73, and we've been stalled out at $72.50. And I think there's good reason for it. Right? I think there's good reason for it. I'm starting to hear about, $100 oil and stuff, and when I hear that, like, nobody talks about $99 oil or $97 oil, right? So how do they come up with that nonsense? And it sounds like Chicken Little, afraid the sky's falling. So it's right. It's funny, and these guys consider themselves professional, but the more I get to know professional traders, or in particular investors and money managers and all this kind of stuff, the more I kind of laugh. I'm like, oh my God. Like if I was a professional, I wouldn't be talking about $100 a barrel of oil. I'd say, well, under current market conditions, the best I could see oil going, between now and let's say the next 60 days is, $76, maybe 79. But you wouldn't be talking 100. What kind of analysis would you use? I guess maybe you could do. I don't know if I can even do this. Yeah, I can't even do annual with this one. Like some people use annual pivots, which I've never done, but And anyways, what would lead you to think $100 a barrel oil? I'm trying to squeeze in the analysis, right? All right, here takes a lot of work to get to 100. So we're how far are we now? We're 70. So we're $30 away from 100. How long did it take us to move $30? So let's do it there. That's our price now. And then we go across. So we were there. How long did that take? That was June 2017 to August. So that's more than a year. So it might be in the cards. Probably not something I would be, talking about now. The other funny thing is those guys are probably talking about $20 a barrel or $10 a barrel here. Now that it's gone this far, they're like, oh my God, I didn't get all this money, but now it must be going up here. It's just funny or sad. Actually, it's probably closer to sad that these guys are on TV and on the radio. Because just by saying it seems like they have no idea what's going on. All right, guys, you keep talking about the pivot points, and here's what I've been saying the last week. I'm building a system so you can download and install it, including my templates, my workspaces or profiles, they're called here, the pivot indicators, all my other indicators, all my files, a video on how to install them, and if you need an opportunity to work with someone one-on-one to get them installed as well. So if you can just wait a few more days, you don't have to ask 72 questions in the chat. Just wait a few days and your problems will go away. Because it seems to me a lot of people download and install it, and then they don't know how to install it, they don't know how to set it up, they can't get it to look like mine, they can't do this, they can't do that. Just wait. Just wait. And all your problems will go away. Well, these problems will go away. Yeah, Brooke says, let's see how they go up. Well, I'm not saying they're not going to go up. It's just, I think I don't think it's a good idea as a trader, someone that's in the market every day, to be convinced it's going to go to 100. That sounds like some investor that has no idea about technical or even fundamental analysis who's trying to talk his clients into just being patient, which means they don't know really what price to buy. They have no idea what price it's going to. It just sounds like a bunch of hot air that they're pitching to people that also know nothing. So it makes a lot of sense. One person that's supposed to be an expert but really doesn't know anything is talking to someone else who's probably very rich and therefore theoretically an expert, but also has no idea what. And they're sitting talking to each other and they're like, yeah, well, it used to be 140, so it should be 100 now. I'm not saying it ain't going to 100. I'm just saying, why would you be talking about that now? There's nothing out there to be talking about that. Right? No, that is not what happened. Yes, I did bomb out yesterday. I apologize for that. Did it have something to do with the new computer setup? And no, I was actually quite sick. Well, Joe says the 95% of failure rate must apply to professional traders too. I'm just really surprised at how amateur people are, even if they have hundreds of millions of dollars under management, how little they actually know. And it's surprising. I was really surprised because I used to look up to people that had that kind of money, and you're like, wow, these guys are geniuses. And then you find out actually they're not. There's just like a little wizard pulling strings, and you're like, wow, right? Like all these hedge fund managers that, remember how hedge funds, they spiked like 300% because that was the new way to get rich. So now all of a sudden, all these idiots started their own hedge funds. And you find out all they did was basically replicate the S&P 500. Well, guess what? All those hedge funds are going out of business now because people found out, well, instead of paying this guy 20% of the profits and 2% management fee, they could have just bought an index fund and paid not 2% plus 20% profit, but actually 0.00125% and no profit sharing. So if you just did that, you would have beaten this other guy and not paid all those fees. So, it was just dumb money going after dumb traders. And these traders were, ex-bankers and all these things. And they actually knew very, very little. And so they'll wash out, and everyone's probably going to start trading pot funds or stuff like that. And that dumb money will chase that. And some people will get filthy, stinking rich, and a lot of people will get filthy, stinking poor. Why? There's the same problems that you see in Forex. When people are focused on getting rich quick, instead of doing their job, loving their job, planning things in advance, treating it like a long-term business, if you get away from the strong foundation of what we do, then you're just another part of the 95%. It doesn't matter, what school you went to or how much money you have under management. See, you have to also remind yourself, and people forget this, the money is easy. You have to have a compelling story as a fund manager. So if you go out to clients because you worked at Goldman Sachs for 15 years, and already, because of your time at Goldman Sachs, all these billionaires, right? And you got all your Harvard friends and stuff. So off you go, and you're like, hey, man, I want to start my own hedge fund. And boom, you got 300 million, and it's not that hard, right? But the guy's still an idiot. The investors are probably, by and large, amateur. So it blows up, and it doesn't happen. And everyone's like, oh, well, that's how it goes. Now, you might have a different situation. Maybe you didn't go to Harvard. Maybe you don't have 20 years at Goldman Sachs. Maybe you don't know billionaires. But what you need is a track record of success that you could go out and sell to somebody. Now, someone else was selling their reputation, but not necessarily a track record. But we need to put you in a situation where if you were standing by the edge of a swimming pool at a cool, swanky party, drinking some fancy cocktail, and some person comes up to you and you're like, what do you do? Oh, I'm a foreign exchange trader. And the guy's like, really? That's very interesting. And it turns out this guy's a billionaire. Can you close that deal? And you're right. No, you didn't go to Harvard. No, you didn't work 20 years at Goldman Sachs. But you got this kick-ass track record of success of steady returns, low volatility, and low drawdowns. And they're like, wow, that's something I'd like to invest in, right? We need to get you there because the money part is actually, easy. The money's out there is what I'm trying to say. The money's out there. There are hurdles you need to overcome. You're not going to go from a $5,000 account to a $100 million account overnight, because now you're going to need institutional investors, and institutional level investors have rules that they have to follow. So, for example, if you have $10,000, an institution just can't say, well, we'll give you 10 million since you're so good. Well, now they basically own your entire fund, and there's rules against that, internal rules for them. And they're like, well, come see us when you got it at least 10 million. So now, you need to stagger this, but it all comes down to what you have to sell. If you don't have the pedigree, then you better have the performance. That's where we need to get you, so you can say, look, here's my track record of success over the last 3, 4, 5 years, and then here's my growth of assets under management, right? So I got the fund here, and then it grew, and then we got some more investors, and then it grew, and got more investors. And if you can keep the steady pace of low volatility, low drawdown, but steady growth, even if it's only 1% a month, you will get to where you want to go because you will start achieving these milestones. People don't want to get rich quick when they're already rich. They want to have steady income with very little risk because they want to live off the income. If they gave you $10 million, they don't want you to lose a penny of the $10 million. But anything you do make for them, that's what they spend on their yachts. That's what they spend on their crazy vacations. That's what they spend on their gambling trips to Vegas, right? The income, not the principal. So they want you to protect the principal. So they don't want you to turn the 10 million into 20 million in a day or in a month, right? No, they want to know just 1% of that a month is going to come in. It's going to grow and grow and grow, and they can spend, and you'll always have that 10M. So anyways, I don't know. I have no idea how we got over here. Sorry about that. You guys got me going on something. Anyways, yeah. Oh, the professionals. Yeah. So here's the thing. I honestly believe you can become significantly better of a trader than even billion-dollar hedge fund managers. You can become better. Certainly, you can become as good. They're not mythical gods. The more you learn that it's not, Oz is not a god, but just a man pulling strings, and there's lots of lights and smoke and sound effects, then you're like, oh my God, really? Yes, you can compete. Yeah, there you go. Only going to 100. It just sounds like a sales pitch founded on nothing. They're like, yeah, in the next year or two, we think it'll probably go up to 100. What kind of analysis is that? It's like dumb. So anyways, here we go. So we got that Aussie. Yep. Now what? Well, it comes down to whether you're still a bull or if you want to become a bear. And then you start making decisions, right? The decision you need to make, and we talked about this, 5 trading days ago, sort of in here, because some of the other pairs, in particular some of these other yen pairs, not this one, but other pairs, hit monthly targets, you have to really start to make decisions here about how do you fit this week into sort of next month's planning. And in particular, the swing trading group, we talked about this a lot, where I'm like, you really have a real challenging decision to make. You should make your decision now, write it down on paper, and then over the next week or two, we will see what happens. Then you can go back to what you decided and the reasons for your decision, and then compare it to what happened, and then write a summary so that you can actually learn from this situation. And the big question was, and maybe I should pick a different pair that actually hit a target. It wasn't Aussie. Oh wait, these aren't yens, no wonder. Let me go to the yens now because I know that was a good one. How do you handle the situation? Let's try this one. Yeah, so we were here during the conversation. How do you handle the situation where you're in week 3, at the end of week 3, in a 4-week month, and you've already completed the target. You've already bought its support, drove it up to your target, and you're done, but there's still an entire week before the new month. How do you handle this week? It's a real valid question because this was the beginning of the month. We bought it. There was the target. We hit it. We're done. Did it collapse? Oh, it collapsed. Right? Yes, they'll say, oh, it was Theresa May and her speech and stuff and blah, blah, blah. But nonetheless, 3 weeks earlier, we said it would go to this price and stop. So as far as I'm concerned, it went to that price and stopped. Great. So now what? Well, the big question is, in your new week, do you buy it? Do you ignore it? Do you sell something on here? And then lastly, when, if at all, do you start buying next month's swing? Okay, and so back then, which was what, Friday of last week, this gray zone down here that I drew was the suggested buying price if you're a bull in the month of October. This was this was still Friday, guys. We were in here. Actually, the price was still up here. So when we did it, price was still up here. And the plan was, if it came down here, if you bought it here, you could hold it for this week, which was the future week at the time, and all of October. Or do you just wait this out? And you just say, okay, this is done. So I kind of described this as potentially, or possibly, sort of a dead week or an inside week. It's sort of like a week inside of a month, but we're done the month. So how do you handle that week? Big philosophical question. And then if you're still a bull and you're trading not just technicals here, but the fundamental seasonality of the play still emphasizes that this could go up for another month or two. What price do you get back in, and how do next month's pivots come into play? And you see that X I just drew now, and you see this here, and you go all the way across, and you'll see, right, 147 was the buy. And we talked about that, it's Thursday today, we talked about that Friday of last week when price was about here. So it continued to fall. Actually, we were still way up here. It could continue to fall, but if you had an opportunity to buy here, the opportunity says, well, you're taking on a lot of risk of buying something that just fell, right? Like crashed. You don't want to get in the habit of buying something that's crashing. But if you buy it at a logical price and there was reasonable reward, that was the price. Now, you can have a good price, but what if there wasn't a reasonable reward, right? So anyways, we're up almost 150 pips from that bottom, but we were up almost 200 from that bottom. Actually, we were up 200 from the bottom if you bought it last Friday. Okay? So now bulls are hoping that this is an up, a down, and now a real challenge into here. But this is not something I feel terribly confident with, because we're still caught in this month's play, and it's not really supposed to go higher. So that's why if you're going to get it at a good price. We talked about if you bought it here, your stop would be really close, right? And now we're hoping up, down, up, and try to get into here, right? And get to this price, which is 151. Not quite. So let's say 150.50. Okay, which is still 200 pips from here. Okay, but because of where we are, it's really unclear. It's very undefined. It could just go back up to resistance again and then just fall. So, so again, the idea of knowing to think about it, I think is important. Then thinking about whether you should be selling this, whether you should be buying it, whether you should stay out, making the decision, justifying the decision, letting it happen, and then go back to see how your decision was compared to what actually happened, and whether you were right or wrong, or what you learned from the situation. Write a summary about that so that you actually, from this, create a real learning experience, and not just trade. And how many times have you heard that type of advice from me? 100 million times? To create a real learning experience, not just trade. Because trading won't make you better. Okay? An amateur golfer goes to the driving range and plows out a bucket of balls. A professional a professional golfer goes to the driving range and is working on the grip, because they just got it, or they're working on this being here instead of here, because here they're coming in low and they're slicing it. So they got to get this a little steeper, and they're working on that. Not just banging out a bucket of balls, but slice, 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 hook, slice, 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 hook, and you're getting really, really good at slicing. Where, professional is cognitively and physically, in this case, working on a very specific thing. And that's called practice. Okay? You need to really look at your trading and say, what can I learn from this situation? How do you handle a week where there's another 5 trading days, but your monthly plan is already done? It's not supposed to go higher. So what do you do as a bull? You just made 750 pips in 3 weeks. What do you do now? Do you think it's going to go higher? Do you hope it's going to go higher? Or do you just take your profit? And what do you do with the rest of the month? Well, look what happened. Did it go higher? No. Did you hope it was going to go higher? Maybe. But right? What was the right thing to do? Take your profit. Then do you get back in later? How do you get back in? Do you use the new weekly pivots or do you use the future monthly pivots? How do you behave? Is this inside week worth trading? Do you typically make money in situations like this, or do you typically lose money? So what should you do relative to what's happened? What would you do next time? If you could speak to yourself in the future and give yourself advice, what would it be? Okay. Right? Bang! What do we do now, huh? Right? Amazing how accurate these targets were, huh? Not only did they go up and hit the exact price, they stopped going up based on our price. Look at the orange line, the cluster of weekly, monthly. Isn't it crazy that we could talk about this 3, 4, 5 weeks in advance and we get this type of accuracy? So with that being said, you should write down what you learned from this situation. How do the weeklies and monthlies work together? And maybe even dailies if you want to do daily, weekly, monthly, right? And how will you trade using these tools in the future? And then ask yourself big questions. Does it always work this way? Wayne talks about seasonality. Well, is it working now? Well, I think we talked about it working in September, didn't we? But we talked about it not working in July and August. Well, why? Right? Luis says, don't trade mediocre weeks. That might be one way of handling it. But what if you just simply traded it differently because you expected different market conditions? Your job, if you're a professional, and your job is to sit down every day and make your clients money or make yourself money so you can pay your mortgage and pay off your kids, right? So your job every day is make money. Well, you can say, well, my monthly swing is dead. Now what do I do? Well, maybe you can make money, but you're no longer thinking like a swing trader. Maybe you just scalp. But look at it that way and say, I believe, right? So let's go back into a smaller time frame. Okay? What we talked about here last Friday was, holy crap! We just hit our target for the entire month. Change your expectations. Change your behavior. What are you supposed to do in a cluster of weekly and monthly pivots? You're supposed to take profit. It's supposed to stop here. Well, there was a time when you didn't know that. A lot of people are just watching it go up and like, oh, I guess I should buy it here and I should keep buying it here and I guess it's going to go up now, right? We're not guessing. That's our price from 3 weeks in advance to take profit. So should you take profit? Well, look at it, right? Make a decision. How should you behave? And then if the monthly swing is dead, well, should you just remove that from your analysis and just say, well, that trade's dead. Can you still make money? Well, this doesn't look that great, right? But also shows you, if CAD was weak and yen is weak, right? Maybe there's other opportunities on other yen pairs, or maybe it was better to just take the week off. We talked about that as being a viable decision. Take the entire week off. Now, when I say that, I also preface it with, if you are a monthly swing trader, you should analyze where your next prices are to buy. For example, if you're a bull, and then look at it and say, oh, well, we're 200 pips away from that. So you can take the week off, but keep your eyes on that 200 pip drop. Right, John says basically turns into summer trading conditions, right, in a range play. Yes, well, maybe. The most important, because we don't know what it's going to do. I have to emphasize that, right? We don't know what it's actually going to do. But what you do know is you need to change your expectations. There used to be traders that would just pray that it keeps going up. And that might have been you guys at one time. Please keep going up, right? Where you should say, aha, we hit it, boom, I'm done, give me all my money, take all your money off the table, stuff it into your bank account, and then you say, aha, I'm going to change my expectations now. I was very aggressively bullish, and now I ain't. Okay? Sherwin Lee, will you please wait till next week, and I'll have an opportunity for you to download and install. Not just the indicators, but the templates. So you simply install these things, open it up in my exact charts and exact colors and exact indicators and exact moving averages, make themselves beautifully available to you. Hey, by the way, look what I found on this cup. Look at the date. November 16th, 2002. All right. South Africa. Nice. I've been doing my best to get this South African rand a little stronger. Getting a little concerned though. Right? It could be challenged in here. Okay? Now what the pivots tell me is I should expect this to drop here. That's what the pivots are telling me. But that is not for sure. And if I was a buyer of dollar and a seller of rand, and there are plenty of reasons to sell the rand, I'd be looking at this as my buy. Okay? So be careful, yo. Drinking from experience. You guys are funny. The gulp of life. Okay. Up, 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 down, down, buy. Up, 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 down, down, buy, right? Just for fun, let's do it this way. Right? Once you're up here, you look left, drag that across, old resistance becomes support. Then it makes a new higher high. So you look left, old resistance becomes support. Makes a new higher high. So you look left, drag that across, the old resistance becomes support. Makes a new higher high. So you look left, look at the old resistance, mark that as a new place to support. Notice this one makes its higher high, so you look left, draw that across. Why did it not work as well? This was perfect, this was perfect, this was perfect, this was perfect. Well, probably because a lot more people got out of the trade because they were supposed to. Okay? And for you swing traders, that's the exact swing and that's the exact target. So what type of trading strategy do you prefer? One of them is simply buy it in here and walk away and let it ride all from 110.50 to 112.50. Do you like that best? Or do you like the higher high, higher low, buy it? Higher high, higher low, buy that too. Higher high, higher low, buy that 3. Higher high, and really honestly, just take profit. So you take profit on 200, 100, and let's say 50. So do you like the 350 pip wave sort of thing, the 350 pip move, or the 200 pip move? Both are fair. One of them is you buy and you walk away and you don't really do anything for 3-4 weeks on end. And these are more like weekly trades. Okay. Right? Which one is the style that you like? This is price action, this is swing trading. And of course, what I've recommended over the years, and I probably haven't done it for a while, you should go to tradersway.com and open up 2 accounts. One account is only for swing trading. And what happens is when you open that account, because it's only for swing trading, you have intent. You intend to swing trade on this account. You're not making decisions like, what should I do on this one? How should I trade this trade? How should I treat this other trade? It gets all very confusing. But if you have different accounts for different strategies, then when you're loading your charts, you already have decided what strategy you want to employ, and that is intent. And when you trade with intent, you get clarity and obviously consistency, right? And now your trade entries are controlled, so you can say, well, on this one, I'm going to buy here because I'm a bull and that's the right price, and then all this kind of stuff. And then you get into your trade, and after a week or so, you move your stop to break even, and then you basically close your trade. Or not close your trade, you shut that account down, and all your swings are set, and you don't have any risk anymore because you moved all your stops to break even, right? And even though you're not running that account, you don't have that account open, you still have your limit orders and stuff, and all of a sudden, pa-chow, 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 you're hitting your profit targets. Great, but those are just swing trades. And then, right, but you're not watching them, so now you open this another account, and it's, let's say, day trading, right? And now you're doing this kind of stuff. You're just trading one over another, over another, over another. And it's another form of trend trading. And once again, you have intent. You're looking at things over the course of, on a 4-hour chart, on a daily chart, on a 1-hour chart. You know what you want to do. You have an idea where you're going. But in this case, you're making smaller time frame type trades. You're managing them slightly different. Okay? And what I want you to do at one point in your career is that you can do both. In fact, you should do both. So what do you guys prefer? What would your number one strategy be? The monthly swing trades, or sort of the How would you treat this? Almost, what would you call this? Swing trades versus day trading. Which one would your number one be? Hmm? Swing trade is good. Swings, swinger, day trading, swing, swing. Seasonal trading. Yeah, sure. Both. Yeah. Yeah, cool. Well, thank you for that. So let's go back over here. Yeah, day trading is a time killer. But you can see if you put the time in, not only could you have made, let's say, the 350 pips because you have multiple trades going on a day trading basis, but you would also be able to swing trade. So the potential there on that one currency pair, if you're a full-time trader where you're sitting down every single day, you'd get the swing trade and you'd get the day trades. So that one currency pair, USD yen, potentially is 550 pips versus someone that just did the swing trade only got 200 pips. You see what I mean? But all right. Gold. Still nothing going on, but we're closer to support than we are resistance, correct? But bear in mind, the premise of our discussion on this one really had to be know when to walk away, right? Know when to hold them, know when to fold them. Those are the swing trades we did. We knew that we should be holding them for 3 weeks. We knew when to fold them when we hit those monthly targets. And then the next thing is know when to walk away. This gold was something that I walked away from, right? I'm just like, no, I don't see it. I don't see the opportunity. I don't see anything. I'm not interested. I'm neutral. You got to know when to hold them, know when to fold them, know when to walk away, know when to run. Never count your pips. All right. I guess euro dollar. So we had last time we met, which was, I guess, Tuesday, said if you're a bull, there's plan A and then plan B. So plan A, you were potentially, in the green a little bit, but it looks like it came back fairly quickly. So you might have been up a day and then down. So I don't know if you're still in that, if you went long. But then look at plan B, is this next gray zone, and it did hold. Look how it wicked down and bounced back up by a reasonable amount of pips, right? $30 pip bounce. So now what you should be doing on a smaller time frame, if you're still a bull on this, is to look for some sort of reversal pattern. If you're still a bull, right? And the reason I say that, it's not that I think it should go up or it must go up, but that if you're a bull, this is the price you've analyzed, aka I analyzed, where it could potentially go up. So it's not that it double bottoms that's important. what's important is it double bottoms at the price you think it should double bottom. Oops. Okay. Or you wait for the higher low, higher high kind of scenario. So opportunity 1, opportunity 2. And what if you're a bear? You already sold this, bro. Okay. So in this case, plan A, plan B. Okay. Now, just to make it clear, on the bearish side, well, one reason for the dollar to be strong is the Fed raised interest rates, but also indicated that they will continue to raise interest rates. That tends to be strong for a currency. And as we saw, blah, 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 blah. Okay. So now what? All right, so the market fights it out for a while, makes a new lower low. How do you trade a breakout? The way that you trade a breakout is let it break out, let it retrace, just like I showed you on the price action trading on the USD yen. On euro dollar, you let it break out, you let it retrace back into a roll reversal, and you sell that. So you should already be short if you're a bear, just trading it like a simple breakout. So if you didn't do that, I don't think you're a bear. Or you're not setting your trades up. If you're a bull, now you have to wait for things like double bottoms and higher highs. Okay. Right now you can see it's actually accelerating, but look at this. It's like 1, 2, 2.5 hours ago, you should have been thinking about getting short. Right? Okay. Pound dollar. So we went through this last week as well. Plan A was to sell at 132. Plan B was to sell at 132.33. Plan C is to sell at 133. Plan A for bulls was simply to buy down here. Now here's the funny thing. If you were a bull on Monday and bought it at 130.50, you're up 100 pips profit. If you're a bear and you sold on, I guess it was Wednesday, and you sold at 132, you're up 50 pips. Did I get this one right? Yeah, so either way, you're either up 100 pips profit or you're up 50 pips profit. And it doesn't matter whether you're a bull or a bear. Bulls bought here, bears sold here, and both potentially right now are profitable. Trying to get they give you every little release, so it's difficult to figure out which one you're supposed to be looking at. PCE 2.0, 3.3 on the deflator. Very interesting. Wow, look at that. I just got crushed by all the commodity news. It's funny, there's so much here that it almost becomes worthless. I guess that's what you care about. really high GDP. But looking at like, we beat it on the PCE, and I think we beat it on the deflator. That was something I used to have to do in economics class all the time, was calculate the deflator. So anyways. So it's kind of like this, like the GDP should not be radically different from what you expected, because your bias is based on fundamental analysis of economic data. Was there a reasonable potential for that GDP to come out like horrifically bad? Like it came out 2.2 instead of 4.2? Most of this stuff is on trend, and we're reasonably accurate with them, right? With the data. So it seems to me this stuff usually works out with your bias anyways. What is most important is that as a bull, you buy where bulls are supposed to buy, and as a bear, you sell where bears are supposed to sell. Now, you might have completely different biases because you've interpreted the economic data differently. But like in this example, bulls are profitable and bears are profitable. Okay? And that's right. And that is buying and selling where you're supposed to be is, I think, and that's an example of it, is the most important thing. Because I can want pound dollar to go up and you can want pound dollar to go down. And we could argue about it all day and give fundamental reasons for it and all kinds of other reasons. And, oh, it's this, it's inflation, it's the Bank of England, it's Brexit, it's the Fed, it's Trump, it's there, right? We can go back and forth and blah, 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 blah. But if you buy where you're supposed to buy and sell where you're supposed to sell, you probably do okay. One of these is likely to win. I mean, one potential is this move sideways. But let's take that away. Let's say it's either going to go up or down. So if you buy and sell where you're supposed to be, then the vast majority of the time, one person will make some money and the other person will make a lot more money. Okay? And the vast majority of losses are people that are trading that don't have a bias, that don't have a plan, that don't understand fundamentals, that don't understand technicals, and they're just the monkeys in the middle, or in this case, pigs, right? If you're a bull, right? If you're a bull, you buy at support. If you're a bear, you sell at resistance. And if you're a pig, you get slaughtered. Okay? So like, for example, if the number came out really bad, it was a ginormous miss, and productivity had collapsed in the United States, pound dollar might have jumped up, and the bear would have got knocked out of break even, and the bull would have made money. Well, that's kind of what you want. Worst case scenario, you're entering your trades so well at exactly the right prices and stuff that you should, even when you're wrong, get in situations where you're moving your stop to break even. And then your losses are break even trades or map trades. Okay? So I want you to focus on that. Plan A, plan B. Plan A, plan B. Are you a bull or a bear? I'm a bear. Great. Where's your plan A? Where's your plan B? What prices? Is this with the current market conditions, or is it against current market conditions? Right? That's what you want to get in the habit of. Right? I've always said I don't care if you're a bull or a bear, because we can disagree and both make money. In fact, I could admire the differences. I say, well, I really respect what you're doing, right? I may disagree with it, but at the end of the day, I'll jump in my purple Murcielago and you'll jump into your yellow Gallardo. And I'll say, well, I've been more rider than you this year, but when things change, I'll have the Gallardo and you'll have the Murcielago, right? So anyways, Swissy, plan A, buy it here. Plan B, buy it here. Looks like plan A is working. Good. Now the interesting thing is, we said on Monday that this would be the buy, and that in here was our target, right? And you should have actually gotten out of this on Tuesday and been done the trade for the whole week. And why? Well, very often it moves sideways or even down. Look at this. You would have given back a lot. And then look at the re-entry here. Actually, let me do it this way, because I already have this marked. You see this? Check this out, right? So this could have been a re-entry, and you're playing the monthly pivots more than you're playing the weekly. Therefore, your target's quite a bit higher. Okay? Or you could have just bought it on Monday or even Friday, but let's say on Monday, taking profit on Tuesday, and taking the rest of the day off. Sorry, rest of the week off. Okay. Nothing going on here. Well, looks like we predicted a double bottom. Got our higher high. So what you do now is look left, and old resistance becomes support, and we call this a 1, 2, 3. Does anybody know the secret word for this setup? What's the code word? Let's see if anybody knows this. Yeah, hammock. It's a long story. We don't need to get into today, but I've taught this pattern over and 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 over. Jimbo says it's a 1, 2, 3. That's true, but that's not the secret word. So anyways, everyone that put in hammock is correct. Or ABCD and stuff like that. Sure, whatever. What the secret word is hammock. Which means I've taught this over and 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 over again, and that this should be habitual for you. That's the whole point. The point of the word comes from a story about practicing so much something becomes habitual. Okay? I once advised someone that was struggling with consistency. I advised them to only trade that setup 100 times in a row. Measure how they did, and then see if we can, get some confidence and consistency out of that. Do they really have all those dumb names? Cup and Handle? They're amazing. Pound Swissy, this is a challenging one. But pound is a challenging currency to trade. Let's go to like a 4 hour, right? It's a tough one. Tradable, but tough. So even though we know this was a collapse, if you're looking at it from a weekly point of view, like collapse off the pound yen, remember? What is the weekly entry on this? Right there. And that weekly entry predicts a top right here. You'd have to be brave to the point of almost foolish. But if you were hardcore disciplined and you followed the trade because it's the trade, you look at it, you're like, this hit my M2. I understand it just collapsed, but that's my M2 and I buy at my M2, right? So you could just be either crazy disciplined or just crazy. And this would have worked for you. So I'm not suggesting it was easy, but it is predictable, right? In my book, I don't talk about buying it at the support pivot, right? I don't say buy it here. I don't say buy it up here. I don't say buy it at M3, right? It's this price here. And let me make it more accurate. Oops. I say buy that price. Well, that's ridiculous, right? That's the price. That price there. That's ridiculous, right? It's actually the, yeah, that's it. So we went not even 1 pip below the exact price. And now we're just a few pips away from the exact target. So what do we take away from this? You don't need this trade because it was scary. Remember, your trading is supposed to be boring. Okay. But the tools we use are accurate. Okay. And that should provide confidence for you in the future, even after a collapse, that some of these currency pairs didn't even move 1 pip below where they were supposed to move. And that if you traded it, right? So for example, how would you have traded this if you opened your charts at 5 p.m. on Sunday and you said, oh my gosh, we're exactly M2. Well, you buy it, and you put your stop below this support pivot, and now you're done. Okay. Right? So you're risking this much. Okay? You're risking this much to gain. That's the conservative target, and the aggressive target is this one. Okay? Does that make sense? Oh, I'm not talking about buying it now. Oh my God. No. We're pips away from where bulls are supposed to take profit. Now, it's only Thursday. Do they take profit at M4? Do they take profit at this top? Do they take profit at R2? We don't know any of that. Is there a psych level in there? So are we going to take profit at 128? We don't know any of that. So no, you cannot buy it here. You'd be an absolute fool. Right? So where should you? Well, nowhere around here is a buy. The buy was down here. That's what I'm trying to teach you guys. This is where you should be brave, not up here. Brave You buy it because you bought a dip and it's at logical support. And you have a defined amount of risk and a reasonable enough reward. Up here is foolish. Now, a lot of people are taught to trade it like a breakout, and you want to buy it high so it takes off and all this kind of stuff. I don't recommend that at all. Okay? So, if anything, and I don't think you'll get a chance today, if you're not in this, the only thing you could do is sell. And for you to sell, that means you're bearish on the pound and bullish on the Swiss franc, which is you need to prove to me or be able to prove to me that you're a bear. If you're just buying it now because it's going up, then like I said, you're a fool. Because A, you're buying it at resistance, and B, you're trading without a bias, and you're buying it now because it's been going up for a few days. Yeah, but how many weeks, how many months has it been going down? Okay? So if you said to me, Wayne, somewhere between, let me mark these prices more specifically, somewhere between that price and this price, I want to get short. And then we zoom into a smaller time frame, like let's say an hour. I'll zoom in even closer. And now you have a trade plan. You're like, Wayne, somewhere between 128 and 129. Okay? Somewhere between 128 and 129. And then you adjust. Well, I want to include weekly and monthly pivots. So 128.80 something, 88, 128.88. And then I'll adjust this. It's just below 129, but 128.88, somewhere in here. You're looking to sell it because, first of all, you're a bear. Right? First, you're a bear, and second, you're at a role reversal. So in here, you're looking for this to collapse, and you're going to sell it hard, and you're going to stay short the entire month of October if possible. Yeah, if you could say something like that to me, then by all means start setting up your trades. What I don't like and what makes me angry is when people are like, they're just winging it. There is no plan. You're like Geithner. Tim Geithner went on TV because he was going to tell the world how the government was going to save us from the financial crisis. And then they postponed the press conference. So everyone's like, oh my God, what if Tim Geithner doesn't have a plan? Well, what if he has a plan but it's not thought out? Or what if he has a plan and he's working on it and it's so good and so juicy of a plan that they just need more time to plan it out? So they delay it a few days. Then finally, the day is awaiting. Now 10 times more people want to watch this press conference. And suddenly Tim Geithner comes out and to unveil the U.S. government's plan to save us from collapse and pure depression, economic depression. And he came out, and everyone after about 4 minutes said, holy crap, they don't have a plan. They delayed the press conference a few days to stall for time to come up with a plan. And then when they didn't have a plan, they decided to print some charts and do some things. And then all of a sudden, Geithner goes up there, freezes in front of the camera, starts sweating, starts babbling, and everyone just collapsed and melted into their chairs because the government had no plan on how to save the economy. Well, is that how you look when you trade? You're like, I have no plan, I have no strategy, I have no idea what's going on, but I'm going to throw down a bunch of money. And I'm going to buy it because my MACD told me to, right? Holy smokes. How depressing that would have been, huh? So anyways. Well, now, Scott, now you're talking about the central bank. I'm talking about the U.S. Treasury. I'm talking about Obama's government. And they decided nothing would be the great thing to do. Now, Geithner, I think, also came up with cash for clunkers, which was really good. That worked. I'll give them that. Lots of people got their old cars, traded in, and bought new cars. And it saved Ford and Chrysler and GM and Toyota and Honda. All right, good. Very nice. Cash for clunkers worked. Everything else, you know, what saved what saved capitalism was Ben Bernanke and the Federal Reserve Bank. What did here's a test for you, pop quiz, right? The global financial crisis began. Stock markets crashed significantly. What did Jean-Claude Trichet at the European Central Bank do in response to the beginning of the global financial crisis? What did Jean-Claude Trichet, president of the European Central Bank, do? He raised interest rates. What did the Bank of England say? It's just a Yankee problem. This subprime, it's nothing. It's nothing to do with us. Just a problem for the Yanks. Like, oh my gosh. That was the Bank of England and then ECB, right? ECB actually raised interest rates. That was at a planned meeting. So every, 6 weeks the ECB meets, right? So 2 weeks, maybe 3 weeks after the ECB raised interest rates, not even at a scheduled meeting, the ECB cut interest rates. Can you imagine the world in which a central bank raises interest rates at a meeting and then suddenly, without a meeting, just booms or starts slashing interest rates, which means I had no idea what was going on and they were making it up as they went. Like, oh my gosh. Even central banks. Amazing, right? You should have been there, guys. It was crazy what was going on. To see, like, the U.S. government, the guy comes out, he has no plan, and he's sweating, and he's nervous, and he's jittery, and you're like, oh my God, this guy's not going to save us. Tim Geithner's not a hero. Holy crap. So the U.S. government's like, they ain't going to save us. Bank of England won't even acknowledge it out of pride. Won't even acknowledge that London is exposed to New York problems. Like, what are you on, man? Like, are you kidding me? Like, London is not exposed to the U.S. market at all? Like, it's just someone else's problem? And then, of course, the European Central Bank, raising interest rates, and then 2 weeks later slashing interest rates. Like, well, what happened in the 2 weeks? Right? Just amazing. Like, we were on our own, guys. Like, we were on our own, and the world was collapsing. And then the Germans came in and said, you know what? We'll fix this. Austerity. Wow. 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 We were there, guys. It was scary. It was scary. Yeah, very, very, very scary. It was the Fed. It was the Fed. Yeah, look at gold. Okay, we can end on gold. It was the Fed, guys. Oh my gosh. Yeah, gold. Yeah, we knew that. It was coming down into support. It's not that interesting. That's where we are now. So what are you going to do? If you're a bull, you're at a plan A and a plan B scenario, right? And if you're a bear, like, who cares? Right, Troy? Troy, you got to get to that point where if you're a bear, you would have sold it up here. Like, I highlighted it multiple times. If you're a bear, you want to sell it high up into here. And it'll probably stop falling either at this price or that price. That's all you can really plan on now. If it breaks out, you can always get back in. But you want to trade it like a range, which we talked about even last week and the week before. You want to trade it like a range. So if you're a bear, you sell it up here. And you should expect it to stop falling at this price or that price. And if you're wrong, it falls further, well, then you could always do a breakout strategy. But now, if you're a bull, this is plan A to buy, and this is plan B to buy, which makes a bear that's still in it vulnerable to giving back profit. But the fact that it's falling, well, if you sold it up here, that's what you expected. So again, it shouldn't be a problem. You see what I mean? Okay? A bear should be going, oh, nice. And a bear should be, oh, look at this. It's falling into support. None of it should be a surprise. Okay? It's only interesting if you're looking at it as a very short-term scalper, and you're making the vast majority of your money on these little candles. Yeah, okay. But I think there's safer ways to make money, right? If you were so bearish, should have sold it at resistance when it was overbought, right? This to me is the much more interesting trade. Okay, so a person that sells there and makes money, that's where you slap them on the back and like, good trade, nice range trade, good job. Someone that sold it here and is now making money on the news trade, okay, you better have the volatility strategy, like it's literally a news trade. But can you see how dangerous it is selling like this was support and this was support, and then we have these gray areas marked as support and all this kind of stuff, and you're selling here? That's not the safe trade, right? That you don't want to make a career of trying to catch that volatility. You want to make a career of these boring trades. And this one, if you're a bear and you sold up here, yeah, you're getting a little bit lucky. And you're like, wow, that news really went my way. But I'm still going to take profit down here on the second level because it's going to stretch out. We'll hit that target, and I'm going to walk, right? And what do you risk by taking profit? Well, you risk it goes a little farther, and you get down here. Well, that's all right because your next plan is to sell the retracement. That's just a breakout strategy, right? So that's why it's okay just to do your job, like either take profit here, take profit there. This new volatility might say, you know what, I'm going to go for the second target. That's all right. That's cool. And if it breaks, good. You'll just sell the next retracement and you get back in. But then where's your next level of support, right? Oh, yeah, we're going to run into problems here. And I feel like I'm missing, my pivots and stuff. So you got to incorporate all of that in there. Okay? And that comes down to technical analysis. So you say, oh, well, Wayne's plan A and plan B maps perfectly over pivot points. Yeah, shocking. Okay? Okay? You don't want to live and die because news went your way. Okay. Look, it collapsed. Should you sell now or should you take your profit? Well, that's for you to decide. So anyways, thank you guys. Peace on earth. May the pips be with you. May our profits be above average. Thank you for being on my team every single day. And please visit tradersway.com if you haven't already and open up at least a demo account. And then one day, please consider us for your live trading account. And like I suggested earlier today, you could have one live account for swing trading. You could have one live account for spot trading, right? If you're, for example, if you want to scalp, you might want to have like scalping the news. News events create risk in the interbanking system, and risk is reflected by an increase in spreads. So it's not a broker that says, ooh, look at GDP, let's move the spreads. That's the interbanking system. The market freezes up just before that, and you lose your liquidity and stuff, and the spreads widen. It's just a function of the interbanking system. Most people don't want to trade right before GDP, and some people do, but the spreads widen and all that kind of stuff. So if you want to make a career of scalping news events, high volatility event-driven strategies, then and you expect spreads to widen around them, you should open a live account specifically that is a fixed spread. Now you might pay a pip more, but you won't than a variable spread, because a variable spread is always trying to get you better prices, but there ain't better prices around news. So what you do is you get the fixed spread one so that you know exactly what the spread's going to be, and you don't have to worry about it going to 17 pips or 8 pips. It's going to be 2.2, and you know that. So you can have a fixed spread just for your scalping account, right? And then you can have a variable spread for your spot, right? And then you can have an ECN, well, maybe I'd do it the other way. ECN for your spot, maybe variable spread for your swing and all that kind of stuff. You can have multiple accounts for different trading strategies, and then take advantage that Traders Way offers you different types of accounts that offer you different strengths and weaknesses, and you can match them to your cognitive trading strategies for each one of these accounts. Just a thought, right? So anyways, once again, thank you for being on my team. Peace on earth. May the pips be with you. May our profits be above average. I'll see you tomorrow, Friday at Forex.today. Oh, and thank you for the likes. Thank you for the likes. I appreciate that. And if I didn't comment on something like a certain currency pair, leave it in the comments, and I'll try to cover that tomorrow, okay? All right, cheers.